What are some key advantages of investing in stocks compared to real estate?
Yeah, I mean, I think I would sort of just say stocks and bonds, right, in a diversified portfolio, right? I think that, the first advantage, of course, is that it's liquid, right? You can monetize that portfolio during trading hours, and a day later get your money. And the transaction costs when it comes to, going into the stock market or coming out are very low, right? We're almost in a zero trading fee environment, as opposed to purchasing a property where you have large upfront costs in terms of broker's fees and legals fees and title fees and mortgage recording tax and on and on and on. And so,
All right, guys, welcome to the Winner Circle podcast, where we explore the strategies and insight that empower you to build a lasting wealth, and not just only lasting wealth, and to achieve financial freedom. Remember the word financial freedom. I'm your host, Jay Adewale, and today we are tackling a question on the minds of many investors. And the word is the wealth dilemma. Should you invest in stocks or should you invest in real estate? So to navigate this critical conversation, I'm excited to welcome our guest, David Wilson. David is a certified exit planning advisor. It's called CEPA or CEPA, who specializes in helping investors optimize their equity compensation, minimize taxes, and craft strategic financial plans aimed at long-term wealth building. His insights are particularly invaluable for high-income professionals and entrepreneurs looking to accentuate their assets growth and secure their financial future. So in this episode, David will provide essential strategies for entrepreneurs looking to maximize their business exit, ensuring they get top dollar for their hard work. It will also discuss how incorporating tax-efficient philanthropy into your financial strategies can help you grow your wealth while leaving a meaningful legacy, whether through donor advised funds, charitable trust, or impact investing. So if you're an entrepreneur, a tech professional, or simply someone eager to navigate the wealth building landscape with confidence, you wouldn't want to miss this engaging discussion with David today. David is currently in the big city, the Big Apple, I'll say it, New York City. So we're going to dive into the wealth dilemma. Should you invest in stock or real estate? Tell us about your journey so far, David.
sure, Jay. And it's wonderful to be here and have this conversation with you. David Flores Wilson. I have a wealth management firm here in New York City that primarily serves business owners and entrepreneurs along their journey and really try to help them make progress around their overall financial life. And so for me, I got started pretty young. My dad was a CPA. I got exposed to sort of little bits of financial literacy at the dinner table, and in terms of the power of compound interest and the rule of 70 and the powerful impact of being a business owner. And so I saw the impact that he made at an early career out of college in investment banking. But then financial planning was my calling, right? It really was my hobby. Out of college, I was helping people out, think through their allocations on 401ks and helping them figure out, okay, well, should I be renting? Should I be buying? And then, I transitioned in 2009 during the financial crisis to financial planning. And so, what we're trying to do is really in just all these kind of different ways, whether it's in tax or real estate or how they invest their money, is to really advance that plot. And so people that, so they can save well, invest correctly, protect what they have, minimize taxes, manage debt, and manage their real estate portfolios as well.
Thank you for that introduction. So now let's just quickly go straight to the topic for today. What are the fundamental differences between investing in stocks and real estate, considering what primary factor, or I would say, what primary factor should someone consider when choosing between the two?
Sure. I would also, oftentimes this is kind of a false choice, right? In terms of, is it just real estate or is it just a portfolio of stocks and bonds? So often real estate can be complementary to someone's liquid portfolio. And vice versa. Real estate can, that portfolio can be there for real estate investors who are primarily real estate investors. But I think where I like to start is real estate appropriate for that person? Right. And then because there's lots of different real estate strategies, and you really have to look internally and say, if I'm going to invest in real estate, what strategy am I going to pursue? And what's my comparative advantage? There's a guy I worked with in investment banking, and he was just always had the hot hand, right? In the early 2000s, he bought a place in the meat packing. Then he bought his next place in Dumbo in sort of the mid 2000s. Then he's moving to Williamsburg and catching that trend. And so that person is just really good at identifying these demographic changes, these surges in income, and just jumping on those trends. But that's not everyone, right? So other people have other skills, right? You might have access to a network of whether it's family members or friends that can really help you manage that, right? In terms of, okay, well, I know architects, and I know people that can clean my properties, and I know people that can come in and fix this or fix that. And your advantage might be that you have sort of a lower price point than if, for example, if I were to go and do that strategy. And for other people, it's a cost of capital, right? You might be able to get a better cost of capital because you have other assets you can leverage and tap into that as sources of capital and go into real estate. So I think it's really just the first step is really identifying, okay, who am I? What's my strategy? And how can I execute this? And am I going to have an advantage? And so often we see people just say, they're kind of outsourcing everything. And I really like a strategy where you can build skills over time. You can get better at it, right? And so whether that's getting a portfolio of multifamily units, doing commercial real estate in a particular region, it's really about getting better and better at the strategy that you're good at. Because I do think that, some people would disagree with me, but if you're kind of all over the place in kind of real estate and you're in commercial and you're in residential, got a little bit in Florida, New York City, California, potentially, you're going to sort of diversify out those returns. I think diversification works really well in the stock market and the bond market as you sort of dampen volatility. But I think that really just developing those skills and really honing your strategy in real estate can be so effective. And then I think, just really being very disciplined, right? And saying, okay, well, I'm going to model out this particular property and I'm going to have assumptions for renovations and rent increases and the growth in my expenses, and really being very disciplined project by project, determining what your internal rate of return is, and then comparing that against your alternatives, right? And so if you're paying more than you typically would, that rate of return is going to go down. And so if, for example, you're able to get a rate of return in the high teens or 20s, well, then, yeah, that's much more than we could expect in a diversified portfolio of stocks and bonds. Because I do think that you need to earn a higher return in real estate to make up for some of its, frankly, its unique characteristics, right? It's passive investment from a tax perspective, but for many people, it's anything but passive, right? You got to fix things, you got to collect the rent, you got to be strategic about these things. You might have to put cash infusions in. And so I think that because it's illiquid and because it does involve your actual work and focus, that you do need a little bit of cushion. So for example, if you're earning 20%, I think that's a pretty good rate of return, internal rate of return. If you think that you're going to, including the rents after expenses and including the capital appreciation, that return is only going to be 8 or 9%. Well, then it doesn't seem to me, at least, again, I could be convinced otherwise, depending on the project, that that's a good alternative to stocks and bonds. So I think, one, knowing yourself internally, being disciplined about those assumptions and modeling out. And then I think this other part of it where, frankly, real estate beats the investments in the stock and bond market is on the tax side. And so real estate investors really need to understand the ways that they can manage real estate, they can buy real estate, they can sell real estate, all with different tax advantage techniques, right? Whether it's 1031 when you sell it, or opportunity zones when you manage it, doing cost segregation studies up front. Maybe you sort of rolled in another property and from a 1031. All sorts of things that can't be done technically in the stock versus bond market. And so, we could talk hours in terms of, right, of all the different tax strategies related to real estate. And they're so powerful. And sometimes they're more impactful than others, right? This is a challenging interest rate environment. And so some of the projects that worked and cash flowed before don't, but there's still opportunities out there.
Right. Thank you for that elaborate information. So from you, from what you're saying, stock is actually has much more potential compared to real estate.
I wouldn't say, it depends on the project. It depends on the person, right? I think
Okay.
that we look at a city like New York City, intergenerational families that have built so much wealth through real estate as they've been able to sort of depreciate those properties and then essentially applying that depreciation, that non-cash expense against income, to have very, very low tax rates on an annual basis. And then they depreciate that property down to zero, and then it goes to the next generation. You get a step up in basis, and then next generation gets to depreciate it again. So I think if you're thinking intergenerationally and you have access to great capital, and you really know what you're doing, well, then real estate can be so favorable. Personally, we look at we have a lot of clients that consider doing flips, and I think then there your margin of error is pretty small, right? Because you got to turn around that property, get that capital work, and then you might be paying ordinary income taxes at potentially the highest tax bracket of 37% plus New York State and city or wherever your locale is. And so I'm always encouraging clients to be tax efficient and to not um, you know, to not, again, some people are just so good at this, but if you're trying to get your return just based on the sales price, that's one particular in time. And so it's a harder game than if you buy something cheap, collect the rent, and make money over decades potentially, right? So it really depends on the situation.
What are some key advantages of investing in stocks compared to real estate?
Yeah, I mean, I think the I sort of should just say stocks and bonds, right, in a diversified portfolio, right? I think that the first advantage, of course, is that it's liquid, right? You can monetize that portfolio during trading hours, and a day later get your money. And the transaction costs when it comes to going into the stock market or coming out are very low, right? We're almost in a zero trading fee environment, as opposed to purchasing a property where you have large upfront costs in terms of broker's fees and legals fees and title fees and mortgage recording tax and on and on and on. And so, oftentimes these things come in and out of favor. And there's obviously been times where real estate as an asset class has trounced the stock market and vice versa. But I think for people that don't have the the will to get better at real estate and to execute a disciplined strategy, and that if you don't have a comparative advantage, well then potentially just investing your money in a diversified index fund with an allocation to bonds and other things, it might be more appropriate for someone that isn't going to do the legwork in the real estate market. That being said, I think oftentimes when people are looking at real estate, we have clients that they have dry powder, right? And so they could sit in T-bills or money market funds or CDs and earn, what is now a declining yield given the Fed cuts, right? And maybe get your 3.8 or 3.9%. You got T-bills, maybe you're not paying the state tax. But over time, if they're not investing those assets in appreciated and earning a return, for example, in the stock market, that when they go to purchase that real estate property, well, then they're competing against other people that actually have been investing along the way. And that those people that they're competing against potentially have more capital. So oftentimes what we see a lot of times is people are, they want to be opportunistic about real estate. And so they're using the stock market, getting as diversified as they can. And then so that they earn a return and they get until they switch out of that market and then go back into the real estate market. And I think that's an advantage where you do that fairly quickly in the markets. And I think that, and again, right, some people are better at, just like some people have a comparative advantage in the real estate market. Some people are really good at picking stocks and sectors or different countries in terms of where their returns are going to be. Oftentimes, if you just want to earn the market return, it's pretty easy to do that in the stock market through ETFs and mutual funds and other things.
Thank you so much. So you talk about other market areas they can actually, invest in. So, but for you now, how important is it for investors to diversify their portfolio? And itself, does this principle of diversifying your portfolio, does it apply to equally to stocks and real estate?
Sure. Yeah, I think this concept of diversification, right? I encourage people to think about their overall balance sheet, right? And so there's three buckets we like to sort of look at when we look at people's overall balance sheet. And let's be smart about how we allocate between these three buckets. So you have your first bucket is just kind of your safety bucket. And in that safety bucket is the cash that you have. And that would actually include the real estate that you live in that bucket, right? Because it's super important that you pay the bills on that. That's the safety thing, right? And so, and then there's what I call this sort of middle bucket, and this, what I would call the market bucket. And so that's the money that's in your 401k, in your brokerage account, that you're essentially earning a market return. If the stock market, for example, is up 15%, so hopefully you're capturing as much of that as possible. And then that third bucket is what I would call this sort of aspirational bucket. And so this aspirational bucket this is where, if you're going to be investing in anything except for cash, your home real estate and the market, and that's where I would consider this aspirational bucket as investment real estate, private equity. If someone has a large concentration to a stock, for example, if they work at Meta or Google and they have a lot of company stock, and I would call it in that third bucket. And so in general, I would say it's hard to say, there's a specific percentage that we want between these three buckets. But I would say that when we do projections for people, we want people to be able to pay for their bill and their expenses in retirement with that middle bucket, right? And then sort of anything above their sort of baseline expenses. And when we run these projection models, that's where our aspirational bucket comes in. And so I think that for most people, you kind of pivot off that middle bucket that's invested in stocks and bonds, and then you kind of add to that real estate bucket. And so in that way, you're kind of diversified, and that middle bucket sort of that market bucket ensures that you on track for retirement. And then this third bucket, what I call the aspirational bucket, which tends to have hedge funds and private equity and real estate. Then that means, okay, well, if you're going to have a second home, you're going to have a retirement where you're going to spend much more. You're going to give money to the next generation. That's where I think we would model out and see if we can do that with that third bucket. And so, to your question of diversification, it's, I really go back to this thing about, okay, well, I want to see people get better and better at what they're doing in real estate. That being said, markets change. And so if you become so good at multifamily residential real estate in lower Manhattan, and all of a sudden it's, the cost of construction or the cost to purchase those properties is no longer attractive, well, then, yeah, I do think maybe looking at other opportunities makes sense. Where are you going to go where you can buy something where you can get a better return? And so for me, it's where does the return matter most? Yet at the same time, when you have too much style drift, I get a little concerned, right? And so it's a balance, I think, between those two strong forces of kind of doubling down on your strengths at the same time, being disciplined about the return, which sometimes will lead you to drift out into other markets.
All right. Thank you so much for clarifying that. So now, as an expert that you are, what advice would you give to someone who is hesitant to invest in real estate due to, the perceived risk that, some that you spoke about?
Well, yeah, I think that for new real estate investors, right, I think it's, we highly encourage people to start small, right, to see if they enjoy it, right? And I think that for some people, we've seen people, they buy their first property and they make that investment, the down payment, they get the mortgage, they start to do the renovations, they rent it out, and then they realize they don't like it. And so I think it's so important to really understand if this is going to fit your preferences and in terms of your personality. And so, because we've seen a couple, for example, in their 60s that developed this amazing real estate portfolio of a dozen or so rentals. It provided a lot of income. And then they got to their 60s and they were really over it. And so, and they didn't want to use a property management company. I think that was the right call to use a property management company, at least for part of it. But it becomes a question of are they going to incur all these taxable gains by selling those properties on a strategy that they worked for a couple of decades to implement? And so I think just really knowing yourself is so important. And because for some people, they live it, right? They live in, they breathe it. They have such a passion for real estate. And those are the people you're going to be competing against. So oftentimes, if you think you're going to get the best price by kind of looking on Zillow, once a month versus someone who's just pounding the payment, just going to showing after showing and really understanding the market. It's just not a fair comparison, right? So I really encourage people to really understand if it's right for them, and then to really become a student of the game if it's something they're interested in.
All right, become a student of the game. So, from your experience so far, being in the industry for many years, can you share an example from your experience where an investor achieved significant wealth through either stocks or real estate? And it would make more perfect sense if you also share the reason for their success, if you know.
Yeah. Well, I think the people that we've seen make the most amount of progress on net worth growth are your serial entrepreneurs. And I would also consider real estate investors, they're entrepreneurs as well, right? Real estate is a business. And so, we have one client that has sold 3 companies, right? He started a company, built it up, sold it, started another company, built it up and sold it, and sold the third one recently. And it's not luck, right? Like the skills it takes to build that business, the connections that person has to build a team internally, the skills it takes to scale on the distribution side of his business. These are software businesses. He's in the trenches and applying those lessons on each successive business. And so as well, he's honing his exit plan as well. And I think he got burned on one exit. It was a private equity that had a big earnout. And the second exit, he's like, no, I'm not doing a private equity earnout. You're going to either offer me most of it up front or we're not selling the business. And so it's really just being intentional about learning from your mistakes, but also having a peer group, right? Having the right people that have also done this. If you're in real estate, well, then yeah, like you should develop a real estate study group. Trade ideas, understand the pros and cons of different investments, and not just learn from your own mistakes, but learn from other people's mistakes, right? And so I think that is when you really invest in your education and you invest in your investment education, it will eventually pay off. We see it on, we don't work with a lot of older clients. Most of our client base are in their 40s. But for the entrepreneurs that we have in their sort of 50s and 60s, it's just muscle memory for them, right? They just know how to make money. They have the connections. They know where to raise the capital. They know how to exit. They know how to scale. And these are skills that are developed over decades. And so you just like investing where the returns compound over time, when you invest in yourself, that also compounds over time. And so, and one day you kind of wake up and you have the skills that are far exceed, what you had before 10 or 20 years ago.
Thank you so much for laying that information down. So let's quickly navigate towards taxes, which is very important. So for you, how do taxes impact returns on both stocks and real estate investments? And for you, what strategies can investors use to minimize their tax burdens in each case? And I
Sure.
just want to add a follow up to it. Are there any tax efficient investment vehicles you would recommend for each asset class?
Sure. I think when it comes to minimizing taxes, this is a year-round sport, a lifelong sport, right? And so it's not possible for sort of everyone to become a tax expert, but if you aren't going to develop the skills, you definitely need the right team. And so, there's just so many different ways that the tax code can be used for individuals, entrepreneurs, real estate investors, for business owners in particular, right? It starts with how you start your company. The entity itself can be so impactful. If you're a C Corp and you sell that business, you might qualify for what's called qualified small business stock, which is a $15 million capital gain exclusion when you sell that business. A lot of people do the S Corp. S Corp can save you some money when you collect a reasonable salary, and you might save some money on FICA. And so as well, the impact of the entity affects all sorts of different things, whether it's the pass-through deduction on what's called the qualified business income deduction. I think most people are aware of some of these deferral strategies, right? So investing in profit sharing plans, Ks, SEP IRAs. And I think the important thing to know is that you're really deferring those taxes, a deduction up front, but you're going to have to pay taxes eventually. And so oftentimes, for example, that makes a lot of sense for someone like myself, where if I get the deduction on the federal as well as New York state taxes, but then maybe I move to Florida or some other low tax state in retirement, and then the money comes out without paying state taxes. So I've achieved an arbitrage. So there's the entity type of things, there's the deferral strategies as well. There's any sort of the business deductions and credits, which most anyone's working with a CPA, they'll be able to sort of take advantage of those. But I also, to get more specific around, for example, in the stock market, one strategy is to every year to continue to tax loss harvest positions that, for example, if you bought a stock at $100 and it went down to 90 at the end of the year, maybe just consider selling that stock, buying something else, and taking that $10 loss and applying it towards your taxes. If you still like that stock, you can kind of go back into the stock 31 days later, but you've captured the loss, you bought something else to get the upside. So that's a strategy I think that people should be implementing. When people have, for example, IRAs as well as brokerage accounts, and maybe they have Roth IRAs. If you put the right securities in the right accounts, you can save money by doing that. And then, of course, in real estate, you just have an endless amount of strategies, whether it's to be able to qualify for real estate professional status, and then take losses from the real estate from one spouse, apply them against W-2 income from another spouse. Again, sort of accelerated depreciation strategies. The tax bill that was just passed has so many different tax strategies, particularly for business owners, including if you're going to put up a factory, for example, right? You put up a factory, you can depreciate the entire amount upfront. Potentially that would even cover the down payment in terms of tax savings. And so just working with the right team, thinking through these different strategies. Yet at the same time, we've seen people, you can optimize taxes so frequently and so pervasively that sometimes you can lose the big picture, right? And so that the business has to lead. Is it a good investment? Oftentimes, we don't want people investing in things or having expenses just for the tax savings. The investment thesis is what should really drive any sort of outlay of capital. And then, of course, we supplement that with tax strategies. Yeah, I think that this investment in the financial literacy is so important, right? And it's a problem in America. Financial literacy is not taught in most schools. We're sort of just figuring it out as we go. If you don't sort of make an effort to really surround yourself and really dive in and listen to podcasts like yourself and dive in and understand from the people that have kind of been there before, right? And so, that being said, there's always new strategies. And so sometimes you have original thinking you can outperform. But to make that informed decision, I really encourage people to think of financial literacy as this skill that you can develop over time, right? I think that we meet people sometimes and say, oh, I'm not good at numbers, I'm not good at money. But after a few years of working together, we have these sort of more elevated conversations. They've read a few books or following some blogs, listening to podcasts, and they're sort of further along. And so that could be sort of inspirational. So I really encourage people just to make financial literacy, a part-time hobby, at least, perhaps.
Any particular platform you were? Are there?
Yeah, I think everyone learns differently, right? So I think that often for me, right, when I'm trying to learn something, I'm going to listen to some webinars. I'm going to jump on podcasts on the topic. I'm going to search them out. And then I'm going to buy a couple books and try to see what I can do. And so for me, it's that immersion that helps. And that works for my particular learning style. And so whatever people's sort of learning style is, it's just go all in on that particular style that is most effective for you. And I think sometimes people are like, oh, well, you should read this book. And if they're not a big reader, well, maybe buy the audiobook, right? Or listen to the podcast that author has been on. And try to find an AI summary or something like that as well, right? Yeah, I think for us, it is pretty early days. We're in a business where we're trying to provide, bespoke, customized advice. A lot of the platforms right now, they might get you sort of 70%, 80% there. And they're going to get a lot better. I personally just used, ChatGPT, for example, just to really understand different industries or metrics around particular stocks or stock sectors. And so internally in the company, we're using, of course, note takers to be more efficient. But in general as well, we're trying to see, okay, well, how can we get more efficient? But at the same time, still provide that human touch and really understand what does the client really need? What are their unique circumstances? And then how do we find opportunities in the markets through tax strategies, estate planning, insurance planning, business planning, all these sort of things. And so I think it's, It's early days, but we're still evaluating a lot of sort of different tools with the emphasis, of course, on trying to maintain the privacy of the data of what we have of our clients, trying to manage all those sort of different factors, right?
Thank you so much. So for those considering philanthropy, because I know we talk about legacy the other time, for those considering philanthropy as a part of their wealth strategy, how can one integrate charitable giving into their investment approach?
Yeah, a couple of different ways. We encourage people that.
Hello, listeners. I want to take a quick moment to share an incredible opportunity for anyone looking to take their businesses to the next level. So, if you're feeling stuck or overwhelmed by the challenges of running a business, most businesses need help right now to navigate out of all this mess, all this hula baloo. So, I'm going to recommend you to check out Point of View Consulting. They are based in New York City and they specialize in offering expert guidance tailored specifically to your needs. One of the things I like about them is their team. They have a lot of team members and they're dedicated to helping businesses of all sizes, whether you're small, whether you're medium, whether you're large. They will help you identify your strengths and weakness. They will also develop effective strategies. For my listeners, or for the listeners of the Winner Circle podcast, you can get 30% off your first consultation by using the code Winner Circle Podcast when you sign up. So whether you're a startup or you're an established company, Point of View Consulting, they offer personalized services that can help you align your objective with practical solutions. So if you're ready to unlock your business potential, you need to visit www.pointofviewconsultingimc.com and use the code Winner Circle Podcast for your special discount. So don't miss out on this chance to work with the industry expert who can provide the support you need to strive. So I'm just going to say it again. Go to www.pointofviewconsultingimc.com. When you get there, use the code Winner Circle Podcast. When you contact them, tell them Jay from Winner Circle Podcast sent you, and use the code Winner Circle Podcast for 30% off your first consultation. So take this step towards a success today. All right, see you next time.
Are interested in making an impact, whether it's a local level or national level for nonprofits, to really start with an assessment of their individual values. What are they really interested in? And then, the next phase is, okay, well, let's understand the causes that you're interested in. And then from the causes, well, what type of organizations do you think will most effectively represent your particular interests and the causes that you're sort of looking to support? Yeah, I think that we have this concept of a nonprofit risk tolerance, right? Or do you want a sort of younger, scrappier organization that is going to try new things, but it may not be 100% effective, right? Or do you want sort of an established nonprofit that your dollars are going to go into this sort of giving impact machine and then have that impact? And so just really doing that due diligence at the personal level, saying, because I think that so many people, when they're giving, they're sort of reacting. And so being proactive instead of reactive when it comes to giving is what we highly encourage people to be strategic about it, right? And then once you sort of identify the nonprofits or the causes that you want to promote and make your investments into, is what is the right way to think about in terms of evaluating whether that impact was made, right? And evaluating the nonprofits, monitoring your investments, maintaining that relationship with the nonprofit. And so you can just have this more fulfilling, more impactful way of giving. Aside from that, of course, since I'm a financial advisor, oftentimes we want people giving in the most tax effective way. And there's kind of different strategies around that as well. Right? For example, anytime someone's going to give $1,000 or more to a nonprofit, and they have an investment portfolio, well, maybe it makes sense to say, you know what, instead of selling this stock that I bought for 100 and now it's 1,000, I got to make capital gains on the $900. Why don't I just give you the $1,000 of stock? I avoid the capital gain and then I still get the $1,000 of deduction. And so I think that's one strategy. I think, many nonprofits are open to that. You get the deduction, it transfers from your brokerage account to their brokerage account, and you avoid the capital gain in the future. So At numbers, when you start to get to bigger numbers, then there's other strategies that can kind of work as well. There's what's something called a donor advised fund. I think the standard deduction is pretty high, right? It's been pretty high since 2017. It just was reaffirmed as this sort of 30,000 or so level. And so many people are not actually itemizing on their taxes. And the way the tax system goes is whichever is sort of higher is your deduction on your tax return, whether your itemized deductions or your standard deduction. And so there's many situations where people, they're giving to charity, but it's not giving them a tax deduction. And of course, that's not the only reason you give to charity. But if you're going to be giving to charity, well, it's great to get that deduction. So you can actually even have more after-tax money, and maybe you can even give in more money, right, to charity and make a bigger impact. And so one strategy is to think, okay, well, if I'm going to give 10,000 this year and for the next 4 years, and I'm not itemizing, so I don't get the actual tax deduction of giving the 10,000. Well, maybe I can bunch all those, the next 4 years, including this year, into one big deduction. And that's where a donor advised fund comes in. So in a donor advised fund, you can give 50,000 to the charity. You can get an upfront $50,000 deduction. And then over time, you can distribute 10,000 per year or however you want. And in between, it actually can grow if it's invested. And so there could be an even larger impact than the $15,000 that you intended. And so that's one strategy. There's all sorts of different strategies. If someone's selling a business and you want an even larger charitable deduction, all sorts of different charitable strategies that can be super tax efficient and where everybody wins, right? You sort of get that deduction, the charity wins, and I guess, of course, the government gets a little bit less money. Right?
Thank you so much for sharing this beautiful information. So as we begin to round off to the last question for today, if our listeners could take away just one lesson from today's discussion about investing in stocks versus real estate, what would you want that to be?
Yeah, I would say invest in yourself first, right? Invest in yourself. And so you'll know whether the stocks are better for you or investing in real estate is. And when you invest in yourself, you can potentially get greater than market returns, particularly on the real estate side, for sure.
For our listeners who are looking forward to reading more about this conversation and also learning about investment on how to navigate the let me say field of investment, portfolio investment. So, you don't want to make mistakes. You want an advisor. So how can they reach out if they need to reach out to you, if they want to learn more about how to invest?
Sure. You can reach out to myself, David Flores Wilson on the blog. I have planningtowealth.com. On the blog, there's all sorts of helpful articles when it comes to different financial planning techniques, whether it's in the stock market or on the real estate side as well. You can set up a time to chat and we can discuss your particular situation if you'd like to do that.
Can you recommend 5 books or 5 resources, excluding Winner Circle, where they maybe books or resources or platform where they can learn more about investing in general?
Wow. I might fire out some books that made sense to me kind of early in my journey, right? Sort of The Millionaire Next Door. I think what's interesting, who I've read recently is pretty good. It's more focused on the sales and marketing part of it is, Alex Hormozy's, his material I think is fantastic. I think I don't know if this is sort of on the investing side, but I found a fascinating book I read recently is Who is Michael Ovitz? Michael Ovitz founded CAA, which is the celebrity agency that basically reinvented the movie industry in the 80s and 90s. And I think that his approach to business was so fascinating when it came to just overwhelming his clients with value. And it's how we kind of live our business here. And gosh, I can go on and on. I think the Vern Harnish's book, Scaling Up, is super. It's a very dense book, but it has a lot of different things for different business owners as they kind of think through what they should be doing with strategy and how they manage people and what they're doing with cash. And so, those are some things that are on my mind recently in terms of the business side.
All right. Thank you so much. And that's a far time spent. And that's the wrap for today's episode of the Winner Circle. I want to say a big thank you to David all again. Thank you for sharing your invaluable insight on the wealth dilemma between investing in stocks and real estate, which is a great information you've shared today. We will learn so much today. And before we close, let's take a moment to reflect on a key takeaway. Whether you choose stock, real estate, or a mix of both, the most important thing is to stay informed, understand your financial go and make decisions that align with your long-term vision. So if you enjoyed today's episode, please take a moment to subscribe, rate, and review the podcast. Your feedback helps us reach more listeners and bring more amazing guests like David to our show. And don't forget to share this episode with someone who might benefit from this insight. So join us next time as we continue to explore more strategies and stories from successful investors, keeping you motivated on your journey to wealth. And until then, keep pushing forward, and remember, in the world of investing, knowledge is your greatest asset. Thank you for listening, and we'll see you in the next episode of The Winner Circle. Thank you, David.
Thank you so much, Jay.